Okay, Mercury Company is another question of audit risk and planning section of AAA, and it is from Kaplan Exam Kit, as you can see. So let's dive in and start with it. It is 1st July 2000 X5. You are an audit manager in Arnett and Co. Are responsible for the audit of a Mercury company, a listed company with a financial year ending 30th September 2000 X5. Mercury Company is the country's leading specialist retailer of small domestic pets, pet food, and pet accessories, operating 264 stores across the country. So, what did we find? We find about the industry. It's a pet industry, and it is a listed company with a financial year ending 30th September 2000 X5. Okay, and it has 264 operating stores across the country. So far, so good. Now, the following exhibits available below for the information relevant to the question. Partner's email, which we have received from the TAD Hastings, the audit engagement partner, the background information matters relevant to audit planning, and selected financial statement extracts from the Mercury Company management accounts, including the results of preliminary analytical procedures which have been performed by a member of the audit team. Okay, cool. Meeting notes. Extract from meeting notes taken at a recent meeting with the finance director of Mercurio Company. This information should be used to answer the question requirement within your chosen response options. Now, respond to the instruction. Email from the audit engagement partner. Knowledge marks 40. Professional marks will be awarded for skills regarding communication analysis and evaluation, professional skepticism and judgment, and commercial acumen. 10 marks. Total. Now, the first exhibit, the two audit manager from Ted Hastings, audit engagement partner, audit planning for Mercurio Company, date 1st July 2000 X5. Hello. With the year end approaching, I need you to start planning the audit of Mercurio Company. Met the company's finance director, Kate Fleming, last week to discuss recent developments. Okay. For the business, I have provided you with a summary of the matter discussed at the meeting, along with some projected financial information. Based on the analysis I have done on this industry, it is appropriate for overall materiality to be based on the company's profit before tax. So this time it is profit before tax, and as it is a key measure for investors and providers of finance. What are the requirements? Evaluate the significant business risk faced by the Mercurio Company. 8 marks. Evaluate and prioritize significant risk of material misstatement which need to be considered in our audit planning. 18 marks. That means 6 to 8 business risks, quality business risks, and 9 to 10 maximum risk of material misstatements will be enough. Please note that you should not evaluate risk related to the audit of animal inventory, as this will be addressed separately at a later stage by an auditor's report as in prior years. Okay. Discuss and conclude on the impact which outsourcing the credit control function will have on audit planning. 7 marks. Design the principal audit procedures to be performed in respect of the holiday pay obligation. Again, 7 marks. Thank you. Now, second required. Mercury Company is a large listed company. Okay. This is a risk. Okay. This is an audit risk. Now, established 15 years ago, founders observed a growth in demand for pet-related products. The company has grown steadily and is now the largest retailer of pet-related products in the country, with over 7,000 employees who are mainly staff working in the stores. Now, it's a pets related company and it's a highly regulated industry. So that's our business risk, okay, which we'll discuss now. As well as pet-related products for a variety of animals, the stores also sell small animals such as rabbits and fish. Staff members are fully trained to give advice to customers on matters including nutrition and general animal health. Staff members are also trained in handling all types of animals which are sold. Some stores sell more unusual pets such as spiders, snakes, and other reptiles and require compliance with specific import restrictions and welfare standards. Okay, so there may be mishandling of pets, which can which can be a business risk for us, as this may cause uh, injury to either to the customer or to the animal, which can lead to the penalties or the you know bad publicity for the company. So this is a risk as well. We found it from here. Now, Mercury Company also operates veterinary clinics with most of its stores. The veterinary clinics are staffed by fully qualified vets who offer a full range of veterinary services. Customers can pay. They go for appointments and treatment of their animals, or they can take out an annual pet healthcare plan, which covers the cost of essential vacations and quarterly health checks. The pet healthcare plans are extremely popular as they offer good value for money to the customer, and the annual income from sales of this plan historically account for 10% of the company's revenue. Now, again, veterinary uh, negligence again can cause to penalties if it was not well treated, if the animals were not well treated. The costs associated with the vaccination health checks have risen over recent years. Mercury Company has not been able to increase the prices due to customer price sensitive over annual healthcare plans. The company accounting policy is to recognize revenue from the sales healthcare plan on the date when the healthcare plan commences. Well, that's our risk ROMM related to IFRS 15, which we will look at later on. Okay, now profit before tax here. Here we will take the range between 5 to 10%. Now revenue is increasing, by the way. Assets related to stores purchased from Lakewell, we will look into it. Trade receivables is increasing. Goods in transit, it's increasing. Cash and cash equivalents, it's decreasing, by the way. Holiday pop pay obligations increased. Employees numbers increased. Okay, bank loans, wow, increasing significantly. Current ratio increasing. Gearing increasing. Now, to expand into two new locations, 20 stores were purchased from Lakewell Co., a clothing retailer, on 1st May 2005 at a cost of 171 million. Mercury Company purchased the stores using its cash reserve. Lakewell Company was facing going concern problems and offered the stores for sale as part of restructuring program. The stores need to be completely refitted at an estimated cost of 9 million each. Okay, 20 into 9, 180 million. Mercury Company management has not yet decided how many of the stores will be retained for use in the business and which are not retained will be sold. The stores will be refitted during the period November 2005 to January 6. Okay, another um, further investment, less cash flow. Again, uh, this is a business risk, right? And furthermore, that they may face, you know, cash issues in the future for it. Regarding it, not practical enough to renovate and operate further enough. If they are lack of cash, they may be able to face getting loans from the bank. Furthermore, we have some ROMM, risk of material misstatement from him, that either the stores which use is not decided yet, either they are classified as PPE, property, plant, and equipment, or investment properties. We have to look at that as well, right? Now, while the majority of the sales are for cash and increasing number of customers have credit accounts with Mercury Company, the company offers credit customers 60 days credit to pay for the good. The forecast trade receivable balance is $42 million, and in 20, it's increasing. One thing, due to growth in sales to customers on account in December, Exo Mercury Company engaged Fair Bank Company, a service organization, to provide the credit control function. Wow. Now, IFRS 9, have they recognized the impairment related to the receivables or not? We have to look at that as well. Now, furthermore, goods in transit. In June 2005, Mercury Company purchased 12 million of pet food supplies from an international supplier with the sales contract stating that ownership of the good passed to Mercury Company at the date of shipping. During the transit, the ship carrying the goods were involved in the accident, which destroyed in the entire supply of goods. Mercury Company directors had arranged insurance on the shipment of goods, and the policy states that 80% of the goods destroyed are covered by the insurance. The latest correspondence from the insurance company was an informal email that the claim had been received and was due to be proceed. These purchases are made in Mercury Company operating currency. So here IS 37 and the provision regarding it. All right, we have to look at, they can recognize as a provision, but it cannot be recognized immediately as a receivable or as an asset. If that happens, that's a material misstatement in the accounts. Okay. Furthermore, Mercury Company has an internal audit department who have been testing the controls in the company's payroll system. Internal audit procedures have revealed that some employees are duplicated on the payroll system. That seems to have happened when two different systems used for recording full-time and part-time staff were merged in October X4. Additionally, internal audit procedure found that while the system has capability of recording holidays taken by staff, this is not always used. Manual records are also maintained in relation to holiday entitlement. Employees are entitled to carry forward a maximum of 3 days of unused holiday entitlement to the next year. Management estimates a holiday obligation relating to unused entitlement at the year end, or using the previous year's obligation and adjusting it for pay rises, changes in staff level. Holiday obligation forecast is increasing as well. So it's related to IS 19. We'll look at it. Note from meeting with Kate Fleming, Mercurio Company Finance Director. This year has been a significant business development for the company. The company has started to sell products under its own brand, introducing the Mercurio range of premium food, pet food, and accessories. The products are manufactured in another country and imported, and purchases of Mercurio brand goods from foreign supplies are predicted to be 7 million for the year to 30th September 2005. The range was introduced for sale in 2005 and was heavily promoted. Heavily been only recently introduced sales of products from the Mercury range will be insignificant in this year financial statement. However, projections in the management accounts indicate Mercury range is expected to account for 30% of revenue in the financial year ending. Oh, it's significant. And how? Let's look at it. During the year, Mercury Company out of an additional bank loan to aid with cash flows for the Mercury brand promotion and the forthcoming refitting of the stores purchased from Lakewell Company. So it's IFRS 9, 15. Okay. Foreign supply 7 million. It's material as well. Okay. Now let's look at the solution now. Okay, now let's look into the scenario. Mercurio Company The email from the partner states that materiality should be based on profit. Yes, and at the start of your answer, you should calculate the range for materiality using benchmark, justify figures within that range. Okay. So far, so good. We have know the about the requirements already. Professional skills, already. Moving ahead now. Briefing notes. Two Tad Hastings, audit engagement partner from audit manager. Subject is Mercury Company audit planning date 1st July 2005. Introduction. These notes are prepared to assist in planning the audit of Mercury Company for the year ending 30th September 2005 using information provided by company's finance director. The business risks facing by the company are evaluated, and the significant risk of material misstatement are identified, prioritized, and explained. Okay. And additionally, discuss the impact which the company outsourced credit control function will have on our audit planning, and finally recommend the principal audit procedures in relation to holiday pay obligation. Now, first of all, materiality. For the purpose of this briefing notes, the overall materiality have to be assessed on the significance of 3 billion, okay, based on the profitability of the company as requested. Okay. Now, how? You have to give the justification using profit before tax of 60 million as suggested. Benchmark, 5% of 60 million is 3 million, right? And 10% of 16 million is 6 million. Now, why I kept 3 million? Here is the, now we'll have to give the justification as well. That so Mercury is an existing client, right? So there should be a higher range that could be, acceptable, but there is a reason of using the lower range, and the reason is the company is the listed, number one. Number two, it has taken out new loans during the year, significantly increasing the level of scrutiny from outside investors. There has also been a significant amount of change in the business operation with the purchase of properties from Lackwell Company since the last financial statement. Due to the increased detection risk, materiality should be set at the lower end of the range. That's it. Now, move on. Business risk evaluation. Firstly, the animal welfare. The company sells animals and pet related products, and there is a business that animal welfare standards are not maintained. The animals which are for sale must be kept in a safe, clean environment, and breaches of any relevant regulation bring risk to the reputation of the company. Any bad publicity or scandal created by ill treatment of animals is likely to attract media attention. Okay, this risk extends into the supply chain, and the suppliers of animals should also have a higher regard of animal welfare. Further, the company should ensure that it is only buying animals from reputable suppliers. To ensure Mercurio Company avoids buying animals which do not have appropriate documentation or have unknown or illegal origin. Veterinary services, we already identified this one. A further regulatory risk arises in relation to the veterinary services offered. There is a risk of employing vets who are not appropriately qualified and experienced, exposing pets to poor quality of healthcare. There is a risk that pets are injured or die while under the care, which will cause for reputation risk as well as having possible legal consequences. There is also a financial risk that a proportion of VAT healthcare plans do not generate a profit or positive cash flow for the company. The cost of providing the veterinary care in some cases may be greater than income generated from the sale of the plan to the customer. The fact that the plans are good value for money for the customer indicates company may generate a very small return even on the plans which are profitable. Mercury company may consider the path healthcare to be a loss leader, where customers are retained by the affordable annual plans and will make profitable purchase on the treatments, pet food, and pet accessories. The business risk remains, however, potentially loss making. Pet healthcare plans can have a significant profit cash flow impact on the Mercurio if the more lucrative additional revenue does not occur. Next one, training of staff. The staff must be appropriately trained. There is a risk that training is not sufficient or appropriate. Staff are required to handle animals and they may injure themselves or an animal if it is not handled correctly. This risk would be particularly applicable to the more unusual animals such as spider and snakes. Inadequate training or a breach of health and safety regulation in the staff handling of animals could result in legal or reputational consequences for Mercury company. This could also be a risk of poorly trained staff mishandling animal as a result causing to the customer. The training in respect of offering nutritional and other advice to customers must also be robust as there is a risk that wrong advice could be given which could result in a significant reputational damage, loss of customer goodwill, and potential claim for damages if customers do not have faith in or are harmed by the advice provided. So far, so good. How many we did? One, two, three. That means 6 marks. Now store expansion. Uh, the acquisition of 20 stores from Lackwell company caused a significant cash flow, and this may put pressure on the company profit, company liquidity. Yo, the stores which are retained need to be refitted, and the estimated 180 million cost of this will put further pressure on cash. The company is not is projecting to only have cash available of 36 million, which would not even cover the cost of refit five of the source. It is unlikely that the company would want to use all of its cash for this purpose, and additional long-term finance may need to taken out. If the company is unable to raise the finance necessary to complete the refurbishment, it may need to halt all or part of the project, which would impact on revenues and cash inflows. It is notable that Mercury company took out a loan during the year, but despite this, there will still a significant cash outflow. In addition, the refurbishment project appears to be running on a very tight time scale. It may be over optimistic to consider that all of the refurbishment can take place in a 3 month period from November 2005, January 2006. Any delays in opening stores will have a negative effect on revenues and cash inflows for the stores which are not retained. There may be problem in selling them on if they are not in good location or in a poor state of repair. So Mercury company may be left with assets which does not want to use and are difficult to sell. The fact that Lakewell company was facing going concern problems could indicate the stores were not a good investment. So fourth one, uh, 8 marks enough in these four headings, but let's do some extra. Mercury brand importing the new Mercury range products from foreign countries, so exposing the company to risk associated with the international trade, such as currency exposure, inflation, and changing regulatory frameworks. With the sales of goods from the range expected to becoming significant next year, the supply chain with these suppliers will become increasingly important. So issues such as dealing with exchange gains and losses will become more significant for the company. This is all the risk associated with the quality of goods produced in foreign countries if regulations are not so stringent in the country of production. There is also a risk that amount invested in the Mercury range does not yield a satisfactory return on investment. The projected sales figures may be over optimistic. It may take longer for the new brand to become established. especially if there are already well-established brands on the market. The company may not have the resource to compete effectively with other brands. Poor quality financial reporting and management information produced by the company systems. There seems to be a risk that business systems are not operating effectively, indicated by the problems experienced with the payroll system. Issues of this type could be replicated other systems, resulting in inaccurate financial reporting and management information. It will be difficult for management to make sound, strategic, and operational decisions if the information they are using is not in for purpose. Controls over payroll do not appear to be effective, and the problems in the payroll system indicate a risk of fraud. Employees' record could have been duplicated or purpose with the objective of paying employees twice. Other fraudulent activities, such as the creation of fictitious employees, could also have happened. There is also a risk of tax implications. If the payroll system and control surrounding are not sufficiently robust, employees' taxes could be incorrectly calculated and underpaid. This is a compliance risk, and the company could face fines or penalties if tax regulation have been not complied with. So, two extra uh, business risks. Now, going ahead, we have another requirement, important one, that is risk of material misstatement, classification and measurement of acquired properties. Water, please. The properties acquired from Lakewell Company are material as they are clearly above the determined materiality threshold. There is a risk that properties are not classified appropriately according to the management intention. The properties which will be refitted should be classified property, plant, and equipment. Any properties which are going to be sold should be classified either as held for sale or investment property, depending on whether the criteria of IFRS 15, non-current assets held for sale and discontinued operations, or IS 40 investment properties have been met. For example, if management is committed to plan for disposal, which is likely to occur within 12 months, and the assets are being actively marketed by the year end, then the properties are likely to meet the IFRS 5 criteria. But if they are going to be held for the longer term, not for future use by Mercurio, then they are more likely to meet the IS 40 criteria. Mercury Company plans to refit the source may mean that they do not meet the definition of five investment property or assets held for sale. There are measurement and disclosure implications of inappropriate classification. For example, investment properties may be measured at fair value, while assets held for sale are measured at lower of cost and fair value, less cost to sale. The properties could therefore be over or understated in value if their classification is not appropriate. Financial analysis pressures on results. Total assets are forecast to increase by 12.6, which is consistent with the new retail shops purchased during the year, as well as increase in trade receivables. The gearing ratio is showing to have decreased by 20 percent points, consistent with the new bank loan, which has taken out to aid with cash flow for the refitting of the retail units and uh, expenditure to support the new Mercury range. Trade receivables are increased by 91%, which is an unusual movement and not explained by the information received from the client. The current ratio has increased by 86% during the year, again, which has not been explained by the discussing with the client to date. The extract from the company statement of financial statement does not sufficient detail on the total current assets and liabilities to explain the movements which have occurred, owing to the fact Mercury Company is seeking new finance for the store furbishments. Professionals' capitalism should be maintained as there is a motivation for the directors to overstate current ratio in order to make more favorable loan applications. Now, the revenue recognition, the PAT healthcare plans create a risk of misstatement in respect of the timing of revenue recognition. With payment being made in advance for a annual plan, there is a risk that revenue is not recognized at the correct time. According to IFRS 15, revenue from customers' revenue should be recognized when the entity satisfied performance obligation. In case of pet healthcare plans, there is a risk Mercurio company has recognized the revenue too early, as the company has a performance obligation up until the end of the health care contract. Revenue should be recognized when a performance obligation under the contract has been performed. For example, when each quarterly healthcare has been carried out, there is a risk of overstatement of revenue and understatement of a contract obligation. Deferred revenue is recognized before a performance obligation has been satisfied. This is clearly a material issue because the income from sale of these plans historically represent 10% of revenue and above materiality threshold which has been determined. There is a pressure for the company to show good financial performance, which is compounded by the company ambitious expansion plan, increased number of stores and new brand. Pressure to return a better performance creates an incentive for management bias that management may use earnings management techniques or other methods of creating creative accounting to create a healthier picture of financial performance than is usually the case. This creates an inherent risk of material misstatement at the financial statement level. Operating profit projected to increase by 56.4, which is in contrast to increases of 7.8 and 7.1% of revenue profit before tax, respectively. Anomaly unexplained information received to date from the client, there is a risk operating profits are being overstated in order to provide overly optimistic perception of Mercury Company. Particularly, it is a key metric in loan applications. Arnett and Co. should exercise caution with classification between profit and loss entries affecting items reported below operating profit, as this may seek to overstate operating profit. Then holiday pay obligation forecast for 30th September S5 is a material balance. The amount of the pay obligation has increased by 81.9%, almost 82 from previous year, which is a significant movement indicating estimate for 2005 may be overstated. In addition, the company has 7,000 employees. Basis of the holiday pay obligation estimated 21.1 million. This given average obligation per employee $3,014, which seems high. Employee numbers have increased by 13% from previous years, meaning that average obligation per employee has risen by 61% from 1871 in 2002. The obligation is based on a management estimate, which relies on management judgment. Therefore, also the inherent risk of management bias. The obligation is calculated on the basis of the previous year's provision adjustment for changes in staffing levels, rates of pay. Previously mentioned, the employee numbers have increased by 13% from the prior year, and there is no indication that rates of pay have changed considerably. Additionally, the lack of controls over the payroll system and the fact that manual records are being used and sometimes holidays not recorded means that management estimate may not be based on robust information. This risk also extends back into the corresponding figure for 30th September 2002. There is a risk that accrual has not been determined accordance with IAS 19 benefits, which requires an obligation to be recognized in respect of accounting accumulating paid absence only. Management may not having considered whether the obligation result in an incorrect determination of amount to be recognized or not, right? The employees are permitted to carry forward a maximum of 3 days of holiday pay, and therefore accumulated pay from prior year is not likely to fully explain the large increase in holiday pay obligation. Finally, the loss shipment, not finally, according to the contract with the international supplier, the ownership of the goods which were destroyed in the transit had passed to Mercurio, and therefore any loss should be recognized in the financial statement. Mercurio is recognizing the goods at the purchase price of how much 12 million in the statement of financial position. This is incorrect. Inventory has been destroyed. The destroyed inventory is clearly above the materiality threshold, which has been determined. The risk of material misstatement, the profit and inventory have been overstated. Management bias could lead to accounting treatment suggesting by the finance director, which work to improve the company's profit and total assets for the year. So, therefore, the insurance policy gives rise to a possible contingent asset. Contingent assets are possible assets whose existence will be confirmed by the occurrence or the non-occurrence of uncertain future events which are not wholly within the control of the organization. According to IS 37, contingent assets and liabilities and provisions, such assets should not be recognized, but they are disclosed when it is more likely than not that inflow of economic benefits will occur. However, when the inflow of benefits is virtually certain, asset is recognized in statement of financial position because that asset is no longer considered to be contingent. The of economic benefits is probable as Mercurio company has received informal confirmation from the insurance company that they are processing the claim. It is therefore appropriate that Mercurio discloses the contingent asset of 9.6 million for the insurance claim receivable. However, it should not be recognized as an asset uh, as a successful payout of the claim is not virtually certain till now. There is a risk of inadequate disclosure or inappropriate treatment of insurance claim. Finally, we will provide some conclusion on overall evaluation. The risk of material misstatement have been ordered with the regard of the estimated magnitude of any misstatement, the likelihood of such an accounting occurring. For example, the purchase of stores, refurbishment is the highest quantitative area which is deemed to be at a risk of material misstatement. Okay. Bias in classification, revenue recognized of the annual pet healthcare plan is estimated to affect up to 10% of revenue, impact prior year figures. In contrast, foreign exchange movements are carried out as standard by many companies and should be at lower risk of material misstatement than other risk of, as outlined above. Now, fine. Next requirement, that is impact of outsourcing credit control function on audit planning. ISA 402 audit consideration relating to an entity using the service organization is the source of guidance for auditors when audited entity choosing the outsource more business activities. The objective of ISA 402, which is relevant to planning the stage of the audit, is that the auditor should obtain an understanding of the nature and significance of the services provided by the service organization and their effect on the user's internal control relevant to the audit sufficient to identify and assess the risk of material misstatement. Okay. According to ISA 402, when obtaining this understanding, the following matter should be considered. Number one, the nature of services provided by the service organization and the significance of those services to the user entity, including the effect thereof on the user's entity's internal control. Number two, the nature and materiality of the transactions process or accounts or financial reporting process affected by the service organization. Number three, the degree of the interaction between the activities of the service organization and those of user's entity. Number four, the nature of the relationship between the user's entity and the service organization, including the contractual terms of the activities undertaken by the service organization. The auditor, therefore, uh, needs to understand the nature of the service which is performed by the Fairbank. A key consideration is whether Fairbank company services are limited to recording and processing transactions, whether they execute transactions, therefore taking on accountability for those transactions. Giving Fairbank is providing a credit control function. The audit firm must understand whether Fairbank is, for example, making decisions about adjustments which need to be adjusted for bad debts or the level of allowance for receivables and the materiality of the amounts involved. For this purpose, the audit firm should conduct procedures at the planning stage to develop this understanding, review the contract between Mercurio Company and Fairbank to understand terms of engagement. Number two, review reports issued by the Fairbank, for example, to determine effectiveness of credit control function. Three, documents how the systems of Fairbank Company and Mercurio Company interface to understand how the credit control function impact on the Mercurio's company accounting records. Okay. Now, finally, the procedures in respect of holiday pay obligation. Number one, discuss with the management the method used to estimate. No, to estimate the obligation, to understand the assumptions used. Confirm that management estimate techniques are in accordance with the requirement of IS 19. Number three, discuss with management and assess the controls around who has responsibility for calculating the accrual and who is reviewed and approved. Discuss with management the source of information which has been used to develop the estimate, confirming whether this is the manual record which have been maintained. Agree the pay rise and changes in staff level to human resource records. Agree staff members from payroll records to the holiday accrual schedules and confirming two numbers included in the management accounts. Okay. Develop a point estimate or range to evaluate management point estimates using information sources based on this discussion with the representative of HR department regarding the company's policy on holiday pay, particularly to determine whether it is accumulating or non-accumulating. Review of a sample of employee contract to confirm their holiday entitlement, whether it is accumulating or non-accumulating. The manual records recording holiday pay leave taken before the year end, an estimate of the holiday pay leave which has not taken at the year end. Okay. So far so good. We are done with the question, and if you have any questions, you can ask me on my WhatsApp, which is giving in on the website or on my YouTube channels with these descriptions as well. And I hope you get it. Good luck. Take care. Bye bye.